Ana Botin, thank you so much for speaking to Bloomberg. What a day for Santander. Your share price is at a 3-year high. Investors say that you're going from strength to strength. Are you happy with your targets?
It's great to be with you, Francine. And yes, it's a new phase of value creation for shareholders. For the first time, we're announcing and committing to double-digit TNAV and dividend per share growth. We also announced a 50% payout from 40 and another buyback. So yes, it's a new beginning for a very exciting period for Santander.
And this is amongst a lot of your rival, a lot of banks actually, and you're trying to do the same. Do you think we're in a new phase for dividend policy overall?
Well, I think European banks are going to do much better. I think Santander is going to do better than others. So the double-digit TNAV and dividend per share should put us ahead at the top end of European banks' profitability and growth for the next few years, but also value creation.
I mean, there's a lot of banknotes at the moment saying that actually probably their forecast will have to rise with it. Is that a sign of success?
Well, you know, what's really important, success is delivering on what you commit. And we delivered on the 2019 Investor Day plans, in spite of COVID, the war in Ukraine, now inflation. And this is really important. And so that gives us a huge confidence that the model works, that our customer focus in market and global scale and diversification actually are providing good returns for shareholders. And this is an acceleration of that delivery. And this is really what matters in what we said today.
And how much of this is thanks to rising interest rates because of the European Central Bank and the global economy? And how much of this is delivery on strategy?
That's a great question. So more, I will say that today, more than half is actually because we are improving every year, and we're going to do much more in the next few years, improving our operating model. And some of it is, of course, tailwinds. You know, it's not healthy to have an economy with negative interest rates. If you're a saver and you get nothing, and European banks did not charge you, and we're a retail commercial bank, so we suffered more than most. And we're giving mortgages out at 10 basis points. That was a year ago. And so, yes, some of it is tailwinds, yes, but it's a normalization of interest rates. It's a normalization of how the system should work. And more than half is what we are actually delivering in terms of a better operating model.
When actually will you start charging for deposits?
So, you know, what really works in our economy is competition. So we are in very competitive markets, and we're adjusting to each market. In Spain, for example, Open Bank, who has grown 350,000 customers last year, our digital bank, is already paying for deposits. So it will depend a lot on each market situation.
So what's next in terms of where that will change? I mean, do you look at it region by region or actually country by country?
No, country by country.
And is there a target country? Like, when do you think that you'll be able to charge on deposits almost throughout all of your operations? So
you know, it depends. I mean, in Brazil, for example, interest rates have been at 12% already for 12 months. You know, Mexico is 8-9%. So it depends very much on each market, how fast the change is going to happen. But at the end, what matters, again, is that we're in competitive markets. We have been, you know, really misallocating capital because, you know, capital was free. And so that is no longer the case. So, you know, again, to me, it's a normalization of the macro of the interest rates.
And are you comfortable and confident that you'll be able to keep the cost of risk under control?
Well, we have already guided for this year. We should be below 1.2. Our through the cycle cost of risk has been around 1%. And at the end, risk is about the whole balance sheet. We have a very strong model in terms of liquidity. We should outperform peers because we're a retail commercial bank and we have local liquidity. 80% of our deposit base across the group is retail, not market funded. So that is a very important part of the overall profile. And yes, we are expecting credit risk to go up slightly, in some cases normalization. But for this year, we've said below 1.2.
Do shareholders now understand the real value of Santander? I know in the past there had been you know, questions about the footprint and whether the actual bank was valued correctly.
So if you ask me what is the one thing that is great about today, is that, you know, the sell side investors today, they're seeing the value of the Santander global scale and global network. This is really important. We've proven it in CIB, in the corporate bank, in wealth management, in payments, and we now the big target ahead is individuals, which is most of the 160 million customers.
So you don't feel there's a Santander discount compared to peers?
Well, absolutely. We're still very cheap, yes. But we, again, our model suffers more than others with negative interest rates. We had some headwinds with the real, for example, with FX. So the key number and the key commitment that should set us apart again, and we were until 3-4 years ago, we were at a multiple, and we will get there again, I am quite certain, because of the combination of a better model, operating across the group. Hector is going to do a fabulous job on that. He's done it. He's done it. He did it in Mexico, did it in the US. At the highest segments, we're now working on individuals, and so I'm convinced we're going to execute on that across the group.
Are you confident overall about the economy, the world economy? I know you were confident 4 weeks ago when we spoke to you on earnings.
Yes.
Are things actually even looking better than they were back then?
Well, I've been saying this for months, not just last week. I've been saying that the strength of demand is so high. And the key number for us as a retail commercial bank is employment. And we are continuing to see very strong employment. Now, that's going to change. How fast, I don't know. There is not a painless way of cutting inflation. And so the question is how high a price you pay. And we have a lot of experience in managing in inflation countries, not just now, but for years. And so the sooner you cut inflation, the better. But you do have to take some pain. And that's going to happen. And by the way, we're in a very conservative risk appetite across our footprint in Brazil, in the US, because yes, at some point there will be, a significant, I think, more slowdown than what we're seeing now. But it will take some time.
But so why is there such a time laggard, to when we started readjusting interest rates and when we could see a potential hit to the labor market?
No, if I could answer that question, nobody really knows. But a combination of factors. So of course, there's the COVID help. There's the fact that, by the way, in many of our core markets, families on average are in a much better situation. There's been a lot of deleveraging, for example, in Spain, even the UK, compared to the crisis of 2008. People don't know that, but if you look at all the numbers, that shows affordability much better than the previous crisis. So there's a lot of strength in the consumer on average. And what central banks don't know is what is the level of interest rates that businesses and families can afford to live with. So far, it seems like this is a level they can afford. For how long, we don't know.
You're really at the forefront of seeing something ugly turn in the economy. Do you have any reason to worry worldwide, but also in the UK?
I define myself as an optimist who worries a lot, worries all the time. As a banker, that's what I should be doing. So that's no different. There will be very uncertain times. Financial markets will be very difficult. It's already difficult for families and businesses that are more vulnerable. Having said that, we're not seeing signs that the consumer is having, on average, issues, and companies, for the time being, are fine. Now, we have some actually very encouraging numbers, for example, in our auto business in the US. So delinquencies are higher, but actually people end up paying for the cars, and so it's quite a big difference. We gave that number vis-a-vis 3-4 years ago. So there are signs that the consumer, in summary, continues to be quite strong, and very important, employment levels are at all-time highs in many markets, and so that is the key number for us. For Santander, the key number is employment, but we have also de-risked in many of our countries. So at some point, when things get more difficult, which they will, we're ready.
How do you view the UK economy? How's that going?
Well, everybody knows the challenges the UK has, but as I said, the families in the UK, the numbers show that they're much better prepared on average than we were in the previous crisis. House prices have gone up, but not as much as in Northern Europe. By the way, Southern Europe, Spain, have one of the best housing markets in terms of supply-demand in Europe, if not the best. In the UK, it's going to be, again, about the companies. How can companies, and how much increase in rates, what are the level of rates they can live with? And the central banks, we don't know that yet.
There's also a push into wealth management, right, across the board. What areas are you targeting for that? And any acquisition plans?
No. So both on the corporate bank and wealth management and payments, what we're doing is taking our global scale to make our local businesses more profitable and with higher growth. So, wealth management includes asset management. We also have insurance. This is a high growth, high return business, which has done really well. It's already a global platform. And this is the key, again, as I was saying. For the first time, we have built the global platforms. We built ones for the whole group. In corporate banking, in wealth, in payments, we're on track for auto, and now it's about individuals. So yes, wealth will be one of the more higher growth
Is there anything in terms of acquisitions that you're looking at, or even divestments in other parts of the business that are doing less well?
We've been divesting for the last 8 years, so we've divested around 10 billion and we've acquired around 5 billion, but in small chunks, And we'll continue to do that as long as it meets our capital return criteria.
And for the moment, you have good deals out there. Do you see, actually, because valuations in certain parts could be depressed, a good buying opportunity?
Our favorite acquisition is people. So bring good people and teams. And we've done that. I'm serious in wealth management. So we've bought some of the European banks' teams and customers, not really companies in the US. We continue to look at that. Yes, given valuations and markets were very high, there's going to be opportunities in alternative asset managers and so on. But if we can go for teams, that's really what we prefer, and we've done that.
In terms of regions, is it US, or are there other parts that look more attractive?
So the corridors where we're leaders in private banking is the Europe, North America, South America, and there we're one of the leaders, and that's where we're focusing on.
Botin, thank you so much for your time today.
Thank you.